Sounds almost too good to be true, right? But in today's investing world, there are ETFs that aim for high monthly payouts using option strategies. Chasing yield without understanding the mechanics and risks is a dangerous game. Here's a guided tour through aggressive, high-yield, monthly paying ETFs. An ETF, or exchange-traded fund, is a wrapper for a basket of assets that trades on exchanges like a stock. Let's clarify what this means. Some ETFs target capital appreciation, some for dividend growth, and others explicitly target income through strategies like covered calls. The advertised yields, sometimes in the double digits, are based on distributions, strategy income, and sometimes return of capital. They are not guaranteed. With that in mind, here are 5 ETFs widely discussed by income investors that aim for high monthly yields. One of the newer entrants is OMA, a Buffett-inspired high-income ETF that holds Berkshire Hathaway shares. Its main income generation is covered call writing on those holdings, targeting a 15% annual distribution rate. The logic behind this is that Berkshire doesn't pay a regular dividend, so Omaha uses option premiums to generate cash flow. However, keep in mind that covered call income limits upside potential in strong bull markets. Another aggressive income play is ITWO, using a daily covered call strategy over the Russell 2000 index. Designed to generate high monthly income via option premiums while providing equity exposure to small cap stocks. In 2025, reports suggest ITWO yields around 14+% annually. You participate in small cap upside until the call options are exercised. In sharp rallies, ITWO might lag. The NEO suite includes ETFs like QQQI and SPYI, overlaying covered calls on major indexes for consistent income. SPYI currently targets monthly income with an annual yield in the 12% range. These ETFs may have more cushion in bear markets, but they still carry volatility. Some of the best-known income ETFs in this space are QYLD, XYLD, and JEPI. They generate yield by writing call options on underlying indices or portfolios. QYLD and XYLD tend to yield high, sometimes in the double digits. JEPI blends equity selection with option overlay, aiming for smoother returns. They tend to underperform in strong bull runs, but in flat or downward markets, the option income can be a powerful buffer. Lastly, you'll see the Global X Super Dividend ETF, SDIV, and Global X Super Dividend US ETF, DIV, mentioned in monthly dividend lists. These funds focus on high dividend-paying stocks globally or domestically. Their monthly pay structure appeals to income investors. They tend to have higher volatility and sensitivity to global market swings. Because they lean heavily into yield-focused names, capital swings can be large. Many of these ETFs rely on selling call options. In strong bull markets, that means you miss out on upside. The options provide income but cap growth potential. The high yields are often based on recent performance. If markets shift, option premiums compress, or volatility declines, yields may fall. Some distributions may include return of capital, ROC, not pure income. That can complicate taxes and principal erosion. High-yield monthly ETFs often live in volatile assets. A 20% drop in the underlying can overwhelm income gains. Dividends may be qualified or non-qualified, depending on holding period and ETF structure. Income from option trading is often taxed as ordinary income. High-yield, active, or derivatives-based ETFs tend to carry higher fees, which eat into net return. Some niche ETFs are lightly traded, which can mean wider spreads and more cost to enter/exit. Allocate a small portion, 10 to 30% of your total investments, to high-yield monthly ETFs, while keeping the rest in core dividend or growth holdings. Monitor distributions, yield trends, and option volatility. Rebalance when yield gets too thin to maintain portfolio stability. Track metrics like SEC yield, distribution consistency, and option premium trends for assessing ETF performance. If yield drops 20 to 30% below target levels for several months, it may signal pressure, so be attentive to those signs. For example, with $100,000 deployed in an ETF yielding 14%, you earn about $972 a month before taxes and fees. Keep in mind how OMA-H targets a 15% annual yield with monthly distributions, an ambitious goal reflecting innovative strategies. When people first hear about ETFs promising 15% or even 20% annualized yields, the reactions are disbelief, excitement, and then doubt. Income like that doesn't appear out of thin air. It's created through specific financial engineering methods, primarily option overlays and leverage. You need to unpack how the distribution is generated, its sustainability in market environments, and align it with your financial goals. Take QYLD, the Global X NASDAQ 100 Covered Call ETF. It appears ideal, holding NASDAQ 100 stocks and selling covered calls. The yields often hover in double digits, attracting investors as a pseudo-income replacement tool. However, examining its total return over long horizons reveals critical underlying realities. The income is real, but it comes at the cost of growth. By continuously writing call options, QYLD is systematically capping its upside potential. When the NASDAQ runs in a bull market, QYLD lags dramatically behind because the calls sold prevent capturing those gains. In flat or choppy markets, QYLD shines by harvesting volatility premiums without missing much growth. Investors holding QYLD, expecting high yield and big capital appreciation, are likely to be disappointed. The fund's purpose isn't wealth compounding, it's income harvesting. JEPI, the JP Morgan Equity Premium Income ETF, has exploded in popularity as it tries to balance the equation. It pairs option income strategies with active stock selection. JEP offers sustainable yields in the 8 to 12% range and retains more upside during bull markets by not overwriting 100% of its exposure. Investors seek the best of both worlds, high income and growth, which JEPI aims to provide. Finance rarely gives you both high cash flow and growth. The art is knowing which trade-off you're comfortable with. Do you want sky-high cash flow? QYLD-style products fit. Want balanced income with growth potential? Consider JEPI or SPYI. Next, there are funds like OMA targeting a 15% annual yield with monthly payments. This is where it gets complicated. Omaha's model relies on Berkshire Hathaway, which doesn't pay dividends. It promises yield by using aggressive option strategies. When markets calm, income from options declines. Funds may need to dip into capital to maintain yields, masking risks. This risk is similar with SDIV, the Global X Super Dividend ETF. Investors must tread carefully. Its yields often look massive, but the total return history shows prolonged underperformance as underlying holdings are risky high dividend names. One critical mistake many income-focused investors make is confusing yield with return. Yield is just the cash you're paid out, expressed as a percentage of the current price. Return is yield plus price appreciation. If you get a 15% yield, but lose 15% in capital value, your return is zero. Understanding distribution composition is crucial. Some high-yield ETFs disclose a significant portion of payments as return of capital. Taxation is another layer. For U.S. investors, qualified dividends receive favorable tax treatment, but option premiums do not. International investors face complexities as withholding taxes reduce effective payout. You need to calculate your after-tax yield, not just the headline number. In fixed income, a 6 to 7% yield is high for corporate bonds. Junk bonds may push into 8 to 10%. Real estate investment trusts often yield 4 to 7%, sometimes 8 to 9% for riskier plays. 15% yields from an ETF are unconventional, not backed by cash flows. It's synthetic income from selling volatility. Compounding accelerates if you reinvest monthly distributions, but matters only if the total return is positive. Investors on QYLD or SDIV often report stagnation or declines, underestimating capital erosion. The yield trap lures investors with promises of cash flow, but often leads to mediocre returns or losses. These ETFs aren't bad. They're tools that work if used properly. For retirees prioritizing income, they can make sense. Consider them yield supplements for diversification, not miracle investments. Pouring life savings into one ETF is unrealistic. Imagine volatility dropping like in calm 2017 markets. Income drops. Or markets crash like in 2008, yet income potential rises with falling equities. In both scenarios, investors face disappointment, either lower income or capital loss. The sweet spot is sideways markets with volatility. But history shows markets don't stay in that sweet spot forever. High-yield ETFs will always have cyclical performance. In Canada, covered call ETFs are popular as investors crave income. BMO and Horizons are examples using similar strategies. In Europe, UCITS products mirror this approach. The hunger for yield is global, and the financial industry innovates. High yield is not free. It comes with structural trade-offs. Investors need to be aware of this. Consider blending your investments. Build a basket of ETFs like JEPI, QYLD, and SCHD to diversify yields. Focus on weighted average yield instead of chasing the highest number. A sustainable 9% can be better than an unsustainable 15%. Entering ETFs when volatility is low can mean lean distributions, but buying after a spike may lock in fatter premiums. Active investors use metrics like the VIX to guide their allocations, adjusting exposure based on volatility levels. Many retail investors are drawn to high-yield ETFs because frequent cash flows satisfy emotional needs, despite lower long-term gains. Advisors often caution against yield chasing, but the industry continues to offer products tailored to this demand. In modern portfolio theory, balancing risk and return is key, yet high-yield ETFs have found their niche in today's environment. They promise bond-like regularity with equity-linked payouts, but the correlation structures matter. If your entire portfolio is equity-based and you layer in high-yield covered call ETFs, you haven't actually diversified away from equities. your capital still rides with the equity market. That's why institutional investors hesitate to use these as substitutes for true fixed income. For retail investors, however, the perception of diversification is often enough. You'll hear people say, "I own JEPI, QYLD, SDIV, and OMA, so I'm diversified." In reality, most of those funds are variations of the same equity income play. Real diversification would involve mixing asset classes that behave differently under stress. Some advisors suggest capping exposure to high-yield monthly ETFs at 10 to 20% of a portfolio, instead of making them the core. Liquidity is crucial for ETFs. While many trade with healthy volume, some, like SDIV, don't. Lower liquidity means wider spreads and potential losses for active traders. In moments of panic, prices can sharply deviate from net asset value. This can spook investors seeing ETFs at steep discounts. For long-term holders, liquidity may be less critical. However, active traders must consider it for managing entries and exits. The ETF industry is evolving, with new high-yield strategies emerging. Funds are experimenting with double-leveraged covered calls. Leveraging dividend stocks can enhance income, but also increases risk. History shows these innovations may not always succeed. Every strategy has a stress point. Investors should remember what happened with mortgage-backed securities in 2008. Products that unraveled during crises due to misunderstood risks. Covered call ETFs, while not systemic like 2008 securities, also illustrate that complexity can hide fragility. Investors crave substantial income. ETFs that pay monthly and offer double-digit yields tap into that demand. Like comfort food, while these investments are easy to understand and rewarding emotionally, they may not always be healthy long-term. The key is moderation. A little can be satisfying, but too much can be harmful. Balance lies in tactical use of these high-yield ETFs while diversifying across strategies. The goal of investing is to ensure your money supports your life goals, peace of mind, and future stability.